the gold market. This is the most exciting I've ever seen. It's like we have a perfect storm. We've got the treasury bond and government debt default. We've got monetization and the resulting price inflation. We've got a big historical wealth transfer where foreign nations are swapping out treasuries for gold. We got big banks that are in trouble. We have the BRICS that are de-dollarizing and looking for multiple options. We've got weaponization of the dollar that's been going on for about 8 or 9 years, and resentment and blowback. We got central banks in a hidden manner loading up on gold. I think the central banks are going to send us to 5 and 10,000. I'll be very plain.
In recent years, the global economic landscape has undergone significant shifts, marked by challenges to the dominance of the US dollar and a growing trend among central banks to increase their gold holdings for diversification purposes. The BRICS Economic Alliance, comprising emerging economies such as Brazil, Russia, India, China, and South Africa, is projected to surpass a GDP of $34 trillion in the next 4 years, reflecting a notable transformation in the global economic order. Dr. JimWillie, editor of the Hattrick letter, highlights the BRICS nations' concerted efforts to diversify away from the dollar, with central banks covertly accumulating gold reserves. This accumulation trend, mainly led by China, Russia, and India, could drive gold prices to unprecedented levels, ranging from $5,000 to $10,000 per ounce. The gold buying spree by BRICS nations, especially China and Russia, began in 2024, indicating a sustained interest in bolstering gold reserves as a hedge against dollar volatility. Beyond mere expansion, joining the BRICS alliance signifies a broader trend of nations shifting away from dollar dependency. In 2024, there has been a notable surge in countries expressing interest in joining the BRICS alliance, with 3 new countries formally submitting their membership applications. The decision on their induction into the alliance will be deliberated upon during the upcoming summit in October, reflecting a collective consensus among member nations. Dr. Willie also underscores the impact of foreign central banks reducing their holdings of U.S. treasuries, which diminishes their dollar reserves and can lead to currency depreciation. Foreign central banks' holdings currently stand at approximately $3.4 trillion, representing a notable decline from previous levels. Their reduced presence in the U.S. treasuries market, now accounting for just 14% of outstanding bonds, signifies a shift in global financial dynamics away from dollar centricity. Come along as we explore the valuable insights provided by Dr. JimWillie. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
The biggest question is, who's selling the gold to the foreign nations? I think it's China, Russia, the Chinese dynasties, the Persians, Iranians, and the Saudis. They're selling gold. The surprise to me was the Persians and the Saudis. When they signed on to the BRICS, they promised to be sources of gold for the BRICS nations. You know, we got an interesting phenomenon now, Chris. I don't even care whether BRICS is signing on more nations. What they're doing now is they're creating a parade of de-dollarization. And after the parade moves well along, a recognized member in the parade will be invited to join the BRICS. And if they say no, it won't stop their de-dollarization. De-dollarization is a way of describing the global gold bull market demand. They're selling treasuries, they're buying gold. Foreigners hold $7 trillion US treasury bonds, but I was told they hold $34 trillion, Chris, in treasury bonds, corporate bonds, and stocks. They own more stocks than they own bonds. Foreign central bank sells treasury bonds and exits the dollar from the proceeds. They reduce their dollar reserves and their currency goes down. Japan sold $180 billion worth of treasuries and their yen currency lost 22%. Now, here was the after effect because it caused shockwaves. It caused a tsunami because foreign holdings of the Japanese government debt, called the JGB, Japanese government bond, they lost 20%. And they started dumping the Japanese government debt. So the Japanese had to react. They printed money to cover their own abandoned foreign held debt of the Japanese government bonds. That caused the yen to go down another 3 or 4%. The Japanese central bank decided we need to abandon our support of the treasury bond and fortify our currency with gold. So now the Japanese are now de-dollarizing in a manner far more effective and thorough than the BRICS nations. The Japanese are now more in tune with the de-dollarized theme of the BRICS nations than the BRICS nations are. The Japanese have not ended their crisis. They're still struggling with trouble in their banks, trouble with their government debt, and trouble with their yen currency. What it means is that a Toyota is going to be cheaper in the United States. They don't want the treasury bill. They don't want T-bills. We're left with a conundrum at the West Coast. The Japanese want to sell us cheaper Toyotas and Hondas and Nissans, and we don't have proper currency to pay them.
Since the beginning of the year, Federal Reserve policymakers have emphasized that any decisions regarding rate cuts hinge upon gaining greater confidence in inflation moving towards the central bank's 2% target. However, recent data suggests that price pressures may trend in the opposite direction, complicating the Fed's stance on monetary policy. According to DrJimWillie, the Federal Reserve's talk of rate cuts aim to stimulate the U.S. economy and prevent a worsening recession or depression by triggering a bond rally. However, the lack of actual rate cuts in late January or February has left the market uncertain about the Fed's intentions, adding to volatility. The issue of debt servicing raises concerns, particularly regarding high government debt levels and their impact on policy flexibility and economic growth. While global debt levels have surged, nuances in debt sustainability exist, such as changes in household debt since the 2008 financial crisis. DrJimWillie advocates for rate hikes as a solution, warning against debt monetization due to its significant repercussions, presenting a challenge for the Federal Reserve in balancing stimulus and sustainability. Let's get back to the interview.
Back in November, they realized that the big banks were going under from unrealized $740 billion in asset losses, primarily with treasuries that were down 30–40%. I heard 45 even. The big banks were insolvent and in trouble. Ooh, this is complex. So the Fed decided, let's trigger a bond rally. Let's talk, and the emphasis was talk about rate cuts. Let's talk about rate cuts and say we need to stimulate the U.S. economy and get out of this difficult situation with a threat of recession, because they don't want to say a worsening depression. So they talked about rate cuts. And in the following 2 months, they did not give a late January rate cut. They did not give a February rate cut. Instead, they said we might not be able to give a rate cut, and that took off the table the rate cuts. They're doing trial balloons on both sides, Chris, to cut and not to cut. Then we had a remarkable situation. In February, they said price inflation is returning. So that was interpreted as removing the rate cuts. Then in March, they said we're going to pay more attention to the labor market than we are price inflation. So that put back on the table rate cuts. I think unprecedented happened. The Japanese cut rates, the Swiss cut rates, Canada talked about cutting rates, and the Americans thought the coast is clear now to cut rates. So we might have a uniform global rate cutting sequence so that the competition of one currency to the other will be eliminated and no one nation will be made vulnerable. But it won't work because the United States stands out with its 34 trillion in debt, growing by 1 trillion every 100 days. There's no way out. I think they're going to do the following. I got to be clear because I have a colleague named Euro Raj, and he's a brilliant fellow. I'm going to tell you what I think. I'm going to tell you what he thinks because we don't agree, but that's okay. And I yield to him. I tend to think there's no way out of this. They have to raise rates. The pain of monetizing our debt is going to be enormous. Okay, let me give you a sequence. If we have to monetize a lot of our debt because there's not much in the way of foreign, okay, Who in his right mind is going to want to show up at an auction if we raise rates? If we lower rates, who in his right mind would want to show up with lower rates when we know that they won't continue with even lower rates? They're going to see it as a chance with the bond rally to dump their treasuries and not show up at auction. That's what I expect. But let me explain what happens. If no one shows up at the bond auctions and we have tremendous amount of supply, like 9 trillion maturing this year. Chris, nobody's talking about it. 9 trillion of long dated treasuries are maturing this year and must be refunded. I don't like that word refunded. We must find funding for it. We're going to have to monetize it. And that will bring about price inflation because it's going to enter in the economy.
The upcoming annual BRICS summit, expected to occur in the latter half of the summer, typically brings together member nations, interested parties, and representatives from the new development bank to discuss various initiatives. This year, expansion and de-dollarization are anticipated to be key topics. However, whether any European countries will choose to attend remains to be determined. Share your perspective in the comments below. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.